Hey guys, how you doing? It's Will Caban, the Mortgage Man, and I'm here to tell you about some significant changes that happened to FHA earlier in the month. Now, these changes are specific to the student loan guidelines, and they're really big changes because what they do is they directly align with conventional loans. And to give you a little bit of context, you know, when we get a loan in, we always want to see what's going to be the best option and the best program for a client. And there's many different reasons why FHA loans can be better than conventional loans, and there's also many different reasons why conventional loans can be better than FHA loans. But the truth is when it came to student loans, we would always look at things a little bit differently, right? So for instance, FHA might have been better for certain scenarios where it was higher loan to value, higher DTI requirements, things like that, and not necessarily favorable when it came to student loans. So sometimes we would have situations where we had to find a mix between putting somebody into a higher loan to value or a higher debt to income ratio scenario, and it just didn't work out because they had student loan debt, and the student loan debt that FHA took into consideration was always at 1%. It was never anything different. You could always try to get amortization charts and all this other stuff, but the truth is it was really difficult to try to get anything lower than 1%. Now, earlier in the month, what happened was they changed the guidelines to coincide with conventional loan guidelines. And how that works is essentially if you have a IDR or an IBR, which is an income deferred repayment plan or an income based repayment plan, you'd be able to use the $0 repayment that you'd have, and that would put you in a position where you can actually qualify with having $0 as your monthly payment. The other significant change that they put into perspective is now instead of using 1% of whatever the outstanding balance is, so for instance if you had $25,000 student loans, we would have to hit you for $250 a month because that's 1% of $25,000. Now it's only 0.5%, and that's actually the standard for Freddie Mac, which is the way that we would normally go if we were looking at student loan debt. And then you could also do some other calculations for Fannie Mae that might get you in that realm and sometimes a little bit lower. The point is though, this is exciting news. Why? Because there's a lot of situations and a lot of clients that have been in scenarios where they haven't been able to get qualified, mainly because the student loan debt, right? It's a really big topic. It's a hotbed topic, so much so that they made changes to it. And I think there's going to be, some more leniency that comes in with some of the things that they're going to look at in the future. So ultimately, I just wanted to throw that on everyone's radar. I think it's exciting news. And of course, if you have any questions about anything, always feel free to reach out to me, Will Caban. Thank you. Take care.